We've acquired about 4 crore Demat accounts as an industry till COVID, and post-COVID, this 4 has become 22. So what we've done since history, we've sort of done 5x of that just in the last 5 years. If you look at India today, like a mid-cap index is done 15 to 17%. A large-cap index is done about, say, 12 to 14% returns consistently. The sort of investors who end up making the most money are actually not the smart ones, are the ones who are consistent and disciplined.
Welcome to Market Pillars Uncovered, the educational series where we bring you powerful insights from leaders shaping India's financial ecosystem. Today we're joined by a young and dynamic leader, Mr. Pratik Oswal, Chief of Passive Business at Motilal Oswal Asset Management. He has an illustrious academic background with a bachelor's degree in mathematics and economics from Emory University, USA, and an MBA from the London Business School, UK. Under his leadership, Motilal Oswal Asset Management has emerged as a pioneer in the passive investment space, offering innovative and cost-efficient investment products to a growing base of retail and institutional investors. In this episode, we'll dive into understanding index funds and ETFs, learning about realignment of index funds, international equity products, triggers for switching mutual funds, India's economic outlook, and the high growth industries shaping our future. Pratik, welcome on board. Thank you so much for joining us today.
Thanks for having me. We forward.
So, first things first, I want you to understand the big picture narrative that's shaping up in the run-up to 2030. Given your extensive research, your experience at Motilal Oswal, how are you seeing things shape up, and what is the outlook going to be like, and who will be the key drivers?
Yeah, so, I think if you look at capital markets as a theme, I think we've had a substantial, I would say run up in the last 5 years post-COVID. I think just in terms of numbers, since Motilal Oswal started in the 1980s, we've acquired about 4 crore Demat accounts as an industry till COVID, and post-COVID, this 4 has become 22. So what we've done since history, we've sort of done 5x of that just in the last 5 years. And still, if you look at the number of unique investors with Demat accounts, it's about 11 to 12 crore. The number of unique mutual fund investors in India is about 5.5 crore. And for a country with such a large population, the underpenetration is massive. So we expect this number to easily be 2 to 3 times over the next 10 years' time. So as a group, we are extremely excited. What we're seeing in terms of the number of new Demat accounts that's coming in is quite consistent. And, we see this, growth to be multi-decadal. So I think as an industry, we have the combination of high growth in the past 5 years, plus still super under-penetration. So I think that combination is very unique to capital markets. And, hopefully we as an industry can, make the most of this entire, wave of, savings changes from bank accounts towards more investment assets. So very excited.
So in light of this very, very promising and bullish outlook that you have, what are the 3 most promising industries that you will be betting on, or you as a firm are betting on for the next leg of growth?
Yeah, so, I'll be honest, but these things keep changing every 2 to 3 years' time. But looking at it from a perspective today, India, if you look at 10 years back, I think the industries that we saw which had huge prominence was, IT, maybe healthcare and financial services. But what we're seeing is that, and India used to be these 3 industries sort of, majority, I would say in terms of growth. But I think what we've seen the last 5 years is that the growth that we've seen is very broad-based, which is great for a country because, we're seeing industries that were completely laggards, like real estate going well, manufacturing, which wasn't really there, now it's doing well. But in terms of the future, I think there are certain industries that we're very excited upon. One is the entire tech ecosystem, the new age tech, not the old school IT. But there are a lot of these, in fact, last 2 months or 3 months, we've seen a flurry of IPOs in the technology space. where investors are finally understanding the nuances about valuations of these large companies that may not be profitable, but that hopefully will have a path to profitability over the next 5 years. So I think the new age tech is something that we're very excited about. We're also very excited about manufacturing. I think a lot of manufacturers globally are looking at India as an additional to China as a house. So I think in terms of diversification, we think that India was not really a manufacturing player, but I think we're seeing more and more coming in. So I think manufacturing is one space, whether it's electronics or defense, is a space that we're very excited about. And third is I think again the non-bank stuff. So like capital markets or NBFCs. So those businesses we're very excited about. Also healthcare. So these are the three, four sectors that we're betting on over the next 5-10 years.
When it comes to, let's say, demand for thematic ETFs, because we're talking sectors, there is, like you said, a lot of interest in new age technology. Yeah. But are you also seeing growth or any signs of growth in subsegments like AI, semiconductors, green energy, again, another very exciting space. So are you seeing that playing out within the ETF passive investing scenario as well?
Yeah, so thematic investing is something which we've been surprised by the sort of demand that is there for thematic ETFs and thematic funds in general. I think if you look at the last 2 to 3 years' time, a good number of launches that have happened in the mutual fund industry have been thematic. So I think, and there has been a lot of demand for those. So I think we haven't seen green energy. It's something that we're working on personally at Motilal Oswal. We're seeing themes like manufacturing, defense, for example, is a theme that has really caught on with a lot of people. So we believe that, from an investing point of view, let's look at it from a customer's perspective. We think that the customer today sees his or her portfolio as very personal, and they're almost looking at it. And if you see, most portfolios are extremely different from each other. And I think thematic plays a very large role because there are investors who are bullish on certain themes, who are bearish. So it adds a layer of customization to the portfolio, which is why there's so much demand for it. And I see that demand going up over time. And also if you look at global portfolios, so it's very interesting. But because if you look at an average American portfolio, it's very interesting because about 80% is super simple. Like you have like a S&P 500, NASDAQ, or a European or emerging markets fund. But the 10% is when people really experiment. They do a XXX leverage Tesla stock or some thematic fund. So I believe I think India it's somewhat similar where people do want to use a small percent of the portfolio to really bet on these thematic ideas. But I would say majority of the demand still tends to be in those, vanilla, flexi cap, multi cap, mid cap sort of stuff.
You've been an early mover when it comes to international thematic products. What drove that strategy so early on at Motilal Oswal? And also, if you could give us some color on how things have panned out with respect to this particular offering in terms of milestones, AUM, etc.
Yeah, so passives is something which. So I used to manage money for people in the US. So I used to work at the startup in the US that managed money for ultra HNI clients, and all my clients, about 800 of them, were 25 plus million in assets, so super HNIs. And I was very lucky, but I got exposed to their portfolios. And I saw that, and this is in 2016, 2018. I saw that most of them have a lot of allocation towards active funds, passive funds. They had some quant funds, they had international funds. They had options in their portfolios for risk management. And when I came back to India in 2019, I saw that index was not really a thing. There was only Nifty and Sensex. And the other thing is that majority of the investments tends to happen in simple vanilla products, like, as I said, multi-cap, flexi-cap. So the idea was that, can we really innovate? There's obviously a lag between innovation in the West and the East. And the idea was, can we stick our neck out and really, I would say, build for the future. So that's how the sort of thing started. Having said that, we've also been unsuccessful in ETFs. So this is our second attempt. We in fact launched a lot of innovative funds in 2009, 2010, but we're very early to the market. So this is actually our second attempt. And this time luckily things have panned out well. I think what we've learned is that when you're first, you either have to be, um, you know, uh, you have to be lucky, or you have to just wait, be patient. In this case, we were patient because we were there for 10 years, but we were also lucky because this time we got it right. So I think what we're seeing is that there is some level of mainstream demand coming in ETFs and index funds today. We're lucky because we were the first ones to launch a bunch of products. The idea was that the definition of index used to be Sensex and Nifty, but the objective here is that can we broaden that definition? So we were the first AMC to launch, like a mid-cap, small-cap, multi-cap index funds. First ones to launch international funds where, we did extremely well. Unfortunately, RBI shut us down there. First ones to launch thematic and also factor investing, which we're very positive on. So the idea was that, we want to have an index fund in every category. So that was the perspective. We're now close to 50,000 crore in assets, started from 0. And I think, we're also done a good amount of market building where, we have done a lot of education. And I think that has helped us build this AUM and also get traction. So those are the things that we've done. I think, as an AMC, we want to do three things right. And I think if we're able to do these three things right, we will do well. One is we want to be innovative. I think out of the 40 unique funds that we have, I would say 30, 35 of them, we would be industry first to launch those funds. So fairly innovative. The second is we want to be number one in education. So just like this podcast, we've done a lot of this stuff over the last 6 years and we've been consistent at it. I think consistency is key. So we've been literally, month in, month out, done something or the other for 6 years straight. And third is, I think, efficiency. So if you look at index funds and ETFs, what you as an investor want to watch out for is high tracking errors or tracking differences. Our mandate as an asset manager is to match the returns of the benchmark as closely as possible. And we have done it extremely well. So I think that has been a good, I would say, success for us. And, I'll be honest with you, how much ever sales and marketing you do, if your funds are inefficient, nobody's going to buy your funds.
That's true.
So I think that has been a big focus for us and we've done well there. So these are the three things we're focused on. And, it's a commoditized industry. I would say it's almost like an industry, unlike active funds where performance speaks, process speaks. In passive funds, there's no performance.
Simply put, what is the difference between an index fund and an ETF, and who are these targeted at? Who are they best suited for?
Yeah, so within passive funds, there are two structures. One is an index fund, the other one is an ETF. Both are tracking a particular index, and there are many indexes. You can have indexes in large cap, mid cap, small cap. You have gold and silver. You have international funds. You have thematic funds. So there are a lot of unique indexes in India, but the objective is to track the returns of the index. Is to not sway. It's not an actively managed fund. But there are two formats. One is an index fund, which is like a mutual fund, where you can do SIPs. Just like you're buying into mutual funds, you can buy an index fund. So you don't need a Demat account. You can set up SIPs very quickly. You can buy directly for the AMC. So that's an index fund. The other one is called an ETF, which is essentially a fund that's listed on the exchange. So you can buy it like a stock. So you can buy an ETF in the morning and sell it in the afternoon. Whereas an index fund, you get end of day NAV. So the idea is that a lot of investors want to lock in a particular price. So for them, ETFs make a lot of sense. A lot of investors want to buy ETFs like stocks. So for them, ETFs make sense. So I would say there are different investors for both. What we've seen is that unlike the US, where ETFs are more tax efficient than index funds, in India, they're exactly the same. So the returns that you can expect from both will be very similar. So we normally tell people is that go with what is convenient to you. And from what we've done, from what sort of research we've done, we've seen that index funds tend to be a lot more popular. They're much more simpler, easy to understand. But essentially, these are two differences between index funds and ETFs broadly.
But to just give a more practical example, let's say there is a young working professional from a metro city, Delhi, Bangalore, wherever, and they have about 10,000 every month to invest. Now, would you tell them that they should invest in an index fund or an ETF? Because what makes more sense for this demographic? Just for an
Yeah,
example.
so I would say keep it simple. It's like investing in a mutual fund. You can just set up a quick, SIP, or if you have 50,000, right?
10,000 a month.
Yeah, if you
Yes.
have 10,000 a month, you can set up a 10,000 rupee SIP into 2 or 3 index funds. That would be a simple strategy. The beauty about index funds is that the reason why they're popular is because one is they're very low cost. So people like the fact that they're low expense ratios. So more of your money is invested in the underlying stock. And second is because they're very easy for selection. For someone looking at a mid-cap fund, you don't have to worry about this mid-cap fund versus that mid-cap fund. You can just buy the index. So I think the simplicity that comes with index funds is very strong. So for a person who wants to do a 10,000 rupee SIP, I would probably say look at maybe 4 index funds. One maybe international fund if you can get access to that. Maybe a small allocation to gold and silver, which I think makes sense. And maybe one broad market fund like a Nifty 500. Those are very simple, easy to understand, and I think they're very effective for long-term wealth creation. So this is what I would suggest.
When there is rebalancing, let's say Nifty 50, Sensex, what actually happens in my investments as a retail investor? What happens to the ETFs I purchased or the index fund that I'm invested in? And do you buy from market only, or are there bulk deals, block deals also involved?
Yeah, so the best part. So when you're buying an index fund, say suppose a Nifty 100 or say Nifty 50 index fund, that's the most popular index fund in India. You're essentially buying the top 50 stocks of India in a single fund. And the thesis is that India is growing, and we expect the top 50 companies to grow at a certain rate because India is growing. What's really interesting is that the stocks that you buy today will be very different to the stocks you will buy in 10 years' time. For example, if you bought a Nifty 50 index in say 2005, you would have seen a lot of infrastructure stocks, oil and gas stocks. Whereas if you buy a Nifty 50 today, you will see financial services, IT. Tomorrow it might be something else. So the beauty about index fund is that you always buy the top 50 stocks at all points in time. So the rebalancing that you talked about helps the index to be relevant over time. Which is why you'll always be able to buy winners in your portfolio because the index is naturally rebalanced every quarter or every 6 months. So that's the beauty about rebalancing. So today maybe something like some consumer stock is there, but it may not be the top 50 companies. The index has this Darwinian way of selection, where if a company doesn't make the cut, it gets thrown out. And if a company that's doing extremely well, like say like a Zomato, it's done extremely well in the last 50 years' time. Now I think it's a part of Nifty 50, but it's come in slowly. So I think that's the beauty about rebalancing, and that's why we believe that having an index fund is something where you'll always be able to buy the best stocks at all times, or the highest or the biggest stocks at all times. So you don't really have to worry about getting things wrong.
Interesting. So automatically, your investments will also pivot the way the index is rebalanced.
Exactly. Yeah. And also I think the beauty of index also is that there's not a lot of churn. So, if you look at historically, a Nifty 500 or a Nifty 50 index has a churn of less than 6-7%. So you're not really doing a lot of churning. If a stock goes up, it'll automatically go up in weightage. If a stock falls, it'll automatically fall in weightage. So I think it's a very good, low cost and low churn and simple way for you to really create wealth, and it's done well. If you look at India today, like a mid cap index is done 15 to 17%. A large cap index is done about say 12 to 14% returns consistently. And what we've seen is, like for example, the US, which is again a big example because they've done this for a long time. The S&P 500 index, which is the world's most popular index, it's been around for half a century. It was launched in the 1970s, and nobody can really match the performance of it over 50 years. So if you're a 25, 30-year-old who is looking to invest for the next 40 years or 50 years till your retirement, index funds make sense. So I think it's a very simple approach. Just last thing is that a lot of people have this misconception that index funds have inferior in terms of performance. What we're seeing is now that was the case about 10 years back, but as of today, we feel like the performances are if you do a simple comparison, they're pretty much at par with most, good active funds. So we believe that performances also may not be a good reason to why you would not select index funds. So I think it's there. It should be people's portfolios. Yeah.
So this is quite insightful and helpful for all the retail investors watching this. But since this is one of the most critical aspects of the performance of a fund, how do people like yourself or funds ensure that they stay ahead of the curve and they are completely caught up with all the rebalancing and other updates that are trickling in?
Yeah, so obviously this is all regulated. So most index funds, ETFs in India are rebalanced either quarterly or semi-annually. And basically we get information from the index provider. So there are two popular index providers in India, BSE and NSE. And they would give us an intimation a day before where they would say that these are the stocks we have to sell, this is the stocks we have to buy, this is the new index. So we make changes accordingly. Almost the entire industry does it on the day of rebalance. So suppose the day of rebalance is 31st March. The entire industry would rebalance it on that particular day. So it's fairly simple and we have to do it at that point of day where first we would sell and then obviously we would buy. So there is a day lag, a day and a half lag. US is very different where you can do it at the same day. But in India, I think there is a day and a half lag between selling and buying again. But obviously it hasn't really impacted performance. But essentially that's what the standard of
turnaround time.
Yeah, turnaround time. And it's fairly, most AMCs follow the same approach. There are obviously a lot of funds out there who game the system, who know which stocks are going to enter and they would take a position there and all of that. That keeps happening. But for us, because we're regulated, we follow a strict approach.
Okay. You also touched upon international funds, and those are the kind of products even you offer here at Motilal Oswal. Where do you see international funds fitting into an Indian investor's portfolio today? And again, what is the right kind of allocation or exposure that one should have in the current market?
Yeah. So I'm a big believer of international diversification, international allocation. We believe that, if you look at diversification, a lot of people have this misconception that if you invest in multiple equity funds, you're diversified. That's not true. What we're seeing is that equity is very correlated. What that means is that if one fund goes down, the other one also goes down in the same way. The correlation of most equity funds tend to be 90% plus. So you're not really getting a diversification. If equity falls, all your equity funds will go down and vice versa. So the only way to diversify that is to invest in, say, a gold or silver or a fixed income. Now the problem with that is that you're giving up a return for lower risk. So is there a way in which you can maintain your return profile while reducing risk? And the solution to that is international funds. What we're seeing is that Indian markets and say the US markets, because they are the most popular, tend to have similar long-term returns. So if you look at the long-term returns of the US versus India, they've been fairly similar. Also, unfortunately, the INR has depreciated quite a bit. So you're looking at another 3 to 4% in returns if you invest in the US. But if you compare it in INR terms, they're both very similar returns, but they move up and down in different times. So when Indian markets do badly, for example, last 1 year, Indian markets have been flat, but the US markets done extremely well. Whereas maybe next year the Indian markets will do well and US markets may not. And that's been happening for the last 25, 30 years. So we believe that every investor should have an allocation towards international stocks. I think we as consumers are increasingly using American products, in our daily lives. So I think it's also in tune with our spending also, our consumption needs. And also I think in terms of return profile also they do pretty well. So I think from diversification, it makes perfect sense. We keep telling people is that if you're allocating less than 5% of your portfolio, then do it. Then don't do it. There's no point. There's no diversification. You're just adding something which you have to worry about. The more you have, the more you have to worry about. But if you are doing, say, a 10 to 20% allocation, that makes sense. Unfortunately, in our case and also our AMC industry, RBI has shut all international funds. So there was some limit, which is not breached, but set by RBI. And as an industry, we're very close to that limit. And because of that, I think we're not able to accept new money.
Yeah.
But a lot of AMCs, including us, are setting up structures in GIFT City. There's LRS as an option as well. So there are ways in which you can invest internationally. Again, investors need to be aware of the costs and the risks associated. So please do your research. It's not as simple as mutual funds. But having said that, I think it's nice to have in your portfolio.
I want to pivot now and talk about people who, let's say, are already invested in the passive segment of the market. What are the triggers for investors for which they would want to, or they should ideally switch from one fund to another or exit a position whenever, what is an ideal situation or a reason for you to trigger that switch?
Yeah, I think you should sell your investments because of two reasons. One is if you achieved your goal. Suppose your goal is buying a house, buying a car, something, retirement, then that's a good time to sell. The other good time to sell is to rebalance your portfolio. I think if you're invested in, say, 4 mutual funds, large, mid, small, and suppose your small cap exposure is 40%, and that 40 becomes 60%. Then it makes sense to sell a bit small cap and buy some large cap.
So the review and rebalancing that you're saying one should do in their portfolio, should it be more periodic or more event-based?
Once a year, it's fine.
Okay.
Periodic, not event-based. It should be periodic because that's more systematic. It's smarter because then you're not phased by market conditions. You're non-reactive to market conditions. So I would say it should never be some event-based. It should always be periodic-based. It should be disciplined like once a year or once in 2 years. I think those are two reasons to why you would want to sell your funds. I think performance is if you are invested in something which does not meet your risk profile. Say you're invested in a super high risk investment where you realize 3 years from now that this is too high for me. Then you can obviously exit that and go into something low risk. But those are the 3 reasons that I can think of. I would never do things tactically. I would never churn portfolios because of performance alone. Why is because there are cyclicalities in performance in India. Index funds have not a very large track record, but if you look at active funds, all active funds in India have cycles of good performance, but also cycles of bad performance. And I think investors, unfortunately, tend to come in after good performance and leave after bad performance. So I'll give a simple example. We have one of the first funds that we launched in our group is Value PMS in 2002. Now it's 23 years. It's a long time, and our fund has done extremely well over 23 years at some 18-19%. But unfortunately, no one stuck around because it's got 4 or 5 really bad periods where performance has not been great, but it's come back. So I keep telling investors is that don't churn on basis of performance. You can churn on the basis of rebalancing, which makes sense if you achieved your goal, or if you're investing into something very high risk that you realize much later that this is too high risk. But there will be and the reason why I say is because you want to minimize taxation as much as possible. So I think people underestimate the beauty about investing in mutual funds as to how you don't have to pay tax your entire life. And you can defer taxes still for the next 30, 40, 50 years. I've been investing for 20 years and 15 years, and I don't think I've paid taxes. Yet. And I don't think I'll pay taxes, to be honest, unless I give away or something like that. But if someone wants to minimize taxes, which I think is a very good strategy, if you spend money, you're paying GST on the spending. If you invest your money in fixed income, you're paying taxes every year. So if you're putting money in mutual funds, you're not paying any taxation. So it's literally the best tax-friendly instrument in India. And I think, and guess what? You only pay taxes on your gains. So, your capital is fine. So I think it also helps you be disciplined. I think if you have the approach of investing for 5, 10, 15 years, that itself is a very good philosophy to have, not from a tax, but also from a return standpoint. What we're seeing is that the sort of investors who end up making the most money are actually not the smart ones, are the ones who are consistent and disciplined. This is one of the only industries where, dumb money outperforms smart money, if I may say. And people who don't have time for investing are the ones who do well because they just let it, compound widely. So anyway, that's my view on selling.
You've spoken a fair bit about the upside, but are there any red flags or pitfalls also when it comes to investing in a passive fund? Anything investors should be concerned about, whether it's management changes or tracking errors or anything else that you would like to flag?
So the regulators done a phenomenal job in regulating index funds. So tracking error is not much of an issue as it used to be 5 years back. In fact, 5 years back, I wouldn't invest in index funds because the tracking errors were extremely high, 1%, 2% types. So it wasn't really investable asset class. But today, I feel like things have really improved. I think, tracking errors are pretty much under control. I would say that investors should think about what they're investing in. I think if you're investing in a thematic fund or say a sector fund or, something or taking a tactical exposure, then I would say investors should really think twice before investing in it. And if they're investing in it, investors should take a 5, 7, 10-year bet, because these things are very cyclical. So I would say that one of the pitfalls I've seen is that there's a lot of interest behind thematic investing, but I don't think most people who are investing have the mental capacity to hold on to these thematic funds because of how volatile they are. So I would say just don't do it. Just don't invest in thematic funds.
Interesting. I want to, again, pivot to a different direction where we started from. Your career trajectory has been very interesting. You've had exposure to not just Indian market, but abroad as well. What has shaped your career in asset management? What would you say was the turning point or one very big moment in your life that has shaped the way your career has panned out?
Yeah, so definitely, I would say a couple of things. One is, the most obvious thing is that I've been exposed to the stock market at age 9, 10, 11. My first book I've read on investing was at 13. Even though I didn't understand it, I read it.
What book was it?
It was it's called The Theory of Investment Value by John Burr Williams. Very complicated book. I don't know why I picked it up. There was this, when you're a kid, you think like something complex is something which is like, it's like some secret sauce, If things are more complex, you got to understand what it means. So I think that was the first book I've read, which actually doesn't talk about investing, but it talks about how the stock market works, which I think most people don't understand. Still, how the entire demand supply equation works and all of that. And after, obviously, before I went to college, I've read 15, 20 books. So I think, knowledge in this industry is delayed and cumulative. So what that means is that, what you read today will make a huge impact in your life in 15, 20 years because you see reality happen ahead of that. So I think having had exposure has been the maximum benefit. I've worked 15 years, but I've been in the space for 25, 30 years. So I've seen markets evolve and I've seen multiple cycles. And I'm also a big student of psychology. So I think, to be good at investing, you have to be good at psychology, not investing.
Yeah.
And second is, I think I've had, as you said, a global experience. So, I'll be honest, a lot of the innovations we've had is basically mostly copycats, from the West to the East. Some innovation, yes. Some personalization, Indianization, yes. But a lot of the stuff that we've got here in the last, so I've launched about 55, 60 funds. I don't think anyone has launched that many funds in India. And this year, we had targets to launch, half of those funds more. We haven't managed to, but that was the plan. So the idea is, is a lot of the stuff we've done is pretty much because of my experience in multiple geographies, and that has been the turning point for me personally.
What about your father, Mr. Motilal Oswal? What role has he played, given his experience? What kind of guidance has he given you for thriving in the industry?
Yeah, so I'm very lucky. I'll be honest. I couldn't have asked for like a better mentor. Imagine like living with a mentor, having breakfast with him. So I think, and also, people underestimate. Obviously, he's a great business person, but he's also a great person. And that I feel like is much more important because I feel like the values are the most important thing in life, and having your values straight at a very early age gives you a lot of mental comfort, and it's just easier to navigate life if you have a lot of safety in your childhood and good values. So I would say, and obviously, he's always, we've never really spoken much about finance and investing growing up. That was more Ramdev ji, who I'm also incredibly grateful of having a lot of interaction with him. Here you can talk about investing for. He's the only person who can literally talk for 18 to 20 hours straight about investing, and he loves an audience.
So we know who to now catch for our next podcast.
Oh yeah, for sure. I mean, yeah, you can. He's the guy who can really like talk about it non-stop. So growing up, obviously, it's nice to have a bit of.
And beyond markets, I mean, how do you unwind when you're not working? Are there any hobbies, interests that you follow?
Yeah, I have a 2-year-old kid, so I think a lot of my time outside of work tends to go there. It's a lot of fun. 2.5 is a great age, so look forward to spending a lot of time with her, playing with her, all of that. I also have a lot of interest. I like I like electronic music, so I end up going to a lot of festivals across the world and also in India. India has become a quite good scene in the last couple of years, so it's good, but yeah, I'm just and also I play a lot of sport. I like working out, so yeah, a lot of so that's where, and obviously I travel a lot with my wife, so yeah, simple stuff, I think traveling with the family,
great,
exploring interests.
Wonderful. Thank you so much, Pratik. It was great, getting to know your perspective on investing and how, the kind of exposure and experiences you've had has built you as an asset manager. Lovely speaking to you.
Thank you so much.
That's all for this episode of Market Pillars Uncovered. Don't forget to like, share and subscribe to Money TV for more insightful conversations with India's leading market voices. Until next time, invest smart and stay informed.